So today what I want to do is we're going to talk equity-linked annuities, but before we do it, I got to give you a little bit of background on options. So I'm assuming you don't know anything about options. So if you have some background on options, you just hold on and see if there's anything you need refresher on. So option is a security. It's a tradable security. You can buy them just like you buy stocks and any other security. It provides an option, not a requirement, for the purchaser to buy or sell something by some future expiration at some dedicated price. So it's an option. You don't have to do it. If you're the buyer, you're the seller, you're at the mercy of the buyer. But if you're the buyer of the option, you have the option to do something. Your option is to buy or sell. What do we call it if it's the option to buy? What kind of option is that? Call option. And then the option to sell. It's a put option. Or insurance. Insurance is an option. We'll get into that later when we talk about the asset liability management side. There's an expiration. So it could be 3 months from now, 4 months from now, a year from now, 2 years from now. You can go out 2 or 3 years on options. And there's a dedicated price. A dedicated price is called the strike price. So the best way to understand it is just do an example. So let's do Apple stock. So here's Apple. Supposedly, if it comes up, it's not coming up, right? So Apple's currently trading, let's say, for $150. For the current price, 150. This is called the underlying. Apple stock is the underlying security that backs the option. The option is based on Apple. Apple price is stock is $150. So let's go out and look at the options for Apple, and let's go out to, let's say, January of 2023. So if I gave you the option to buy Apple between now and January 2023 at a price of $190, would that be valuable to you? You can buy Apple today at $150. Would you want to pay someone money for the option to buy Apple at $190? I have a lot of students say, no, there's no value to that, but your finance and actuarial students, is there value to an option? You don't have to buy it. If it's worth, if you can buy it for $130 in January, you can buy it for $130, you don't execute the option. But when would you execute this option? If you're trading for $220, would you execute the option? Buy them for $190, you would. So there's value to that. Well, let's see what the stock market says. So the right to buy them at 190. There's 190. And you would pay $1.49. Option, the call option premium. It's $1.49. You pay $1.49 today. And in January, you can buy Apple stock for $190, or you can do it next week if you wanted to. You can execute. These are American options. You can execute anytime you want to. So if next week Apple's trading for $160, what would you do? Nothing, right? You just sit on the option. If Apple were trading for $120 in 3 weeks, what would you do? Why do you think this option would be worth then? If they fell from 150, 120, and you had a right to buy on 190, what do you think the option price would do? Probably drop pretty dramatically. What if they're trading for $300? What would you do? Would you buy Apple for 190? You'd probably just sell the call option, because the call option is going to reflect the fact that they were deep in the money. I had a put option. I probably made a mistake on this, but I had a put option on the S&P that had a strike of 3,700. So it went into the money this week. So I decided to sell it because I get a pretty good premium for it. Now, if it crashes, I'm going to be upset that I sold it, that option, but it looked pretty good to me. We'll see. But it gave me some protection. That's the put option. These are call options. This call option at 110 gives you the right to buy Apple for $110, but they're charging you $45 for that. You'd be stupid to buy this option for $45 and turn right around and buy Apple for $110, because that's going to cost you $155. What could you have done instead? You could have just bought the stock for $150, so that wouldn't make sense. But could you do that by pay $45? Well, if the stock goes up to 200, then you would execute, and then you get all your money back, and you would have done really, really well. So these down here are called in the money options. You're in the money options because if you own this option, it makes sense for you it doesn't make sense for you to buy it today and execute the option. But if you bought this option weeks ago, you want to buy Apple for 110 because it's trading for 150. So that's in the money. Up here, if you have this option at 190, there's no reason to execute this option today because Apple's trading for 150. Why would you execute the option at 190? You're going to wait and see if the stock gets above the option price. So this is called out of the money. And then what's this one called? The 150. That one's right at the money. Maybe a little bit off by $1 or so, but it's just right at the money. And it's pretty expensive, $14. What do you notice as you go into the money? The options get really expensive. When you're out of the money, you know there's an optional Apple stock at $250. You can buy it for 6 cents. If you think Apple might just take off, Apple at $250, my word, that'd be like what, a $4 trillion company? They'd be starting to compete with Saudi Arabia's Aramco. It'd be a really, really valuable company. Probably even more than 4 trillion. Be a really, really valuable company. All right, so that's the option premium. You would pay $1.49, and then sometime between now and January 2023, if the stock never gets up to $190, you lost $1.49. You just threw that away. You wasted $1.40. You lost 100%. But you're a lot better off doing that than buying the stock at 150 and it falls down to $100. Then you would have lost $50. So with the call option, the most you can lose is that $1.49. But if the stock really takes off, you could make a lot of money. If the stock goes to $200, my word, you buy the stock at 190 with the option, you turn right around and sell it at $200. You made $10. You only paid $1.49 to do that. That's a really large return. So option gives you these very, very skewed returns. How do we know how much this option is worth? $1.49. Well, we have Black-Scholes formula that tells us, there it is right there. That's how much a call option is worth. And it's not a particularly complicated formula. The N is just a normal curve. So essentially what they're asking is how far away is that strike price from the current price given what? What do you think can be really important there? What else do you see in there? S, what is S of T? That's the current stock price, that $1.51 or $150. N of D2, here's D1 and D2. K, anybody even know what a K stands for? Any baseball players? What is K in baseball? Strikes. What did I just talk about? The strike price. If you're a bowler, what do you use? Use an X. So sometimes the strike price is a K, sometimes it's an X, depending on you're a bowler or a baseball player. I always learned it as an X, so I guess I was a bowler. I'm not good at either one of them. The ERT, the E is that continuous compounding minus R. What do you think R is? It's the risk-free interest rate. And what do you think T is then? Times. So you're doing time value money depending on when the expiration is, January. So essentially what we're doing is we're discounting this option to January using the risk-free rate. And then what are D1 and D2? So we're taking the log of the current stock over the strike. Essentially what we're doing is we're seeing how far is the strike from the current price. And we're going to adjust that for interest rates. And then what is this right here? Sigma squared. What is that? That's the volatility of the stock price. The more volatile the stock price, the more valuable the option is. Why? Because it's more likely it's going to go above 190 bucks. If the stock's really, really volatile, you got a better chance of it going into the money and be worth it to you. And then again, T is in there. Again, as T is in there. So the most important number in all of this is that volatility. The more volatile the stock, the more valuable that option. Now you don't need option pricing for our exam. It's a good formula to know. I memorized this formula. I don't have it memorized anymore because I don't use it anymore. But I memorized it for the CFA level 2 exam, and I actually got to use it on the exam. It was actually pretty valuable to me. So that's the formula. We actually memorize this formula, and how many people actually have it memorized? There's probably a few option traders out there that do, but probably most of them don't have it memorized. They just have it plugged into a calculator that they can use. It's not the only model. You also have the binomial. So there are other models out there, but Black-Scholes is the most popular one. So this $1.49 is reflecting what the current stock price is, $150, what the strike price is, that 190, how volatile the stock is, how much time until expiration, and then what interest rates are. The most important input of all of that is probably the volatility of the stock. That's going to have the biggest impact. All right. So why is this $1.49 and not $1.30 or $2? Because the stock market has an opinion of how volatile Apple's stock's going to be, because everything else we had in that list. So you got the stock price, the strike price, you got time to expiration, you got interest rates, you have volatility. For these numbers we know today. So those are numbers we're very confident today. What's the big unknown? How volatile will Apple stock be over the next 4 months? That's the big unknown. So that's the one that has the biggest impact on that decision. And you can't, these are not difficult formulas. You can just, you get the normal curve out of Excel, that everything you have. I had this formula built at UTSA because they were hiring executives from publicly traded companies, and these executives had stock options. And UTSA had to tell them, hey, here's our bonus system. How much better is that than your stock option? So I would have to plug in numbers into a stock option pricing model to let them know, hey, how much is this executive's stock options worth versus what UTSA is paying them? And I would use the Black-Scholes formula to do that. So these are just pure inputs, simple inputs, and the formula itself, not that difficult formula. You could very easily set up this whole formula in Excel without any trouble whatsoever. Or if you wanted to, You go to the cboe.com, and the cbo.com has somewhere in here the option pricing model, but I never know they changed their website because I can't remember where it is, but somewhere in here they have an option pricing model. And if you find it, if you ever find it, it used to have its own link. Anyway, so CBOE is a really good site. They do have some really good videos and other things to help you, because their goal is for you. There we go, option calculator. There you go, right there. Their goal is to get you the trade options. So that's one calculator. Here's another calculator down here. So expiration date, you'd put that in there. The option strike, there's where we put the 190. The stock price, there's where we put the 150. The volatility, you could look at the historical volatility of the stock price, maybe the last 6 months or last 90 days, and put that in there. Current interest rates, are they paying a dividend or not? That can affect the price some. And when you do all of that, you get one. They have a model where you can actually input the current option price, and it'll tell you what the implied volatility is. And that can be pretty important too. So all this stuff is out there for free. You can plug all this stuff in here. We won't go into the Greeks, but it's not that complicated. So I was looking at a GameStop. I looked at GameStop when their stock price just went off the charts. You could have bought a call option on GameStop, a month before that happened. You would have been a very rich person. If you put like $10,000 into that, you'd been worth millions and millions of dollars. That thing just went off the charts. That's why they had a stock that's trading for 20 bucks and suddenly it's trading for 400 bucks. If you bought like a $40 strike, you would have been very, very, very wealthy. So I don't know what their options are trading for now. I don't know, it's such a bizarre world. So they did a split to get them back down to more normal levels. But their option prices are still fairly significant. Interesting stock. I don't know if you do Bed Bath and Beyond. Look at their options. You got a $6.38, 48 cents. It's almost 10% of the stock price is what you got to pay in the option premium. Pretty significant. Remember, Apple was $15 for $150 stock. It depends on what they think volatility is going to be and what the value is going to be. You can see the outstanding interest on this, or the open interest and the volume that's been traded. Look at the implied volatility. Pretty high implied volatility. Compare that to the to Apple. Did I get Apple? Implied volatility 41%, 50% versus 200 something percent. So the market's telling you what they think about this stock. If you think this volatility is too high, then you sell the options and you're going to get overpaid for the option, because the higher the volatility, the more valuable the option. If you think their applied volatility should be 25%, then you sell the options and you would, you get to keep the benefit of getting paid too much for the risk. All right, so that's how options work. Insurance is an option. So when you buy auto insurance, you're paying what? You're paying a premium, and essentially it's a put premium. So it gives you the right to sell your car to State Farm at the strike. What's the strike? Cash value. So you have the right to sell your car to State Farm at the cash value. When would you do that? Probably when you totaled your car. It'd be a really good time to sell it. Would you want to do it now? Or why would you want to do that? You have to pay the deductible. What are you going to do if you sell them the car at cash value? You go out and buy the same car for cash value minus commissions and all everything else. You know, there's no reason to do that. But if you total your car and it's worthless, and you can sell it to them for $5,000 at the cash value, yeah, you would do it. So insurance is a put option on your car. And you pay the premium to the insurance company, and they give you the right to sell your car back to them at the cash value. All right. So how does this apply to life equity-linked annuities? So let's just work through the example. This is one of those that the easiest thing to do is just work an example. So someone comes in and they buy an equity-linked annuity. They give you $200,000 up front. I'm ignoring the caps and the floors and all the other things that they had in that article. We're just going to make it really straightforward. And you guarantee them a 1.5% return. It's an 8-year contract. So you're guaranteeing them 1.5% on $200,000. Boy, I did this a long time ago. So the S&P is at 1450. It's not at 1450 today. It might be there next Tuesday, but today it's at what, 3,900 or something, or 3,600. So I did this, you know, probably, oh man, right after the 2008 crisis. The S&P got down to what, 667 in 2009 or something like that. So I probably did this in 2010 or something, but yeah, this is a really low number. On the exam, I'll give you the actual S&P. It'll be right at the money. So that's the level of the S&P 500. You're going to do an at the money call option. So what is your strike price? 1450, because that's what the S&P is. So that makes it easy. Don't come and ask me what the strike price is, because I'm telling you that because it's at the money. 1450. That premium is $500. Now, some of y'all know options and know they trade in contracts. And an option contract has 100. There's 100 options in a contract. We're ignoring that. All right. So we can do one option, 2 options, 3 options. So don't worry. If you end up needing to buy 58 contracts, 58 options, and you know you can only do options in 100, ignore that. We can do 58 options. All right. So don't worry about that 100 contracts. We can go out and buy a 0 coupon 8-year bond at 4.5%. So what are we going to do with all that information? So let's work through this. Again, we're going to work other problems from the prior exam. We probably won't do that tonight because I want to I think what I want to do is email you a prior exam question and have you work it before Thursday's class. So there's a few steps here. So step 1 is how much do we need in 8 years to the fees guaranteed? And Bill Gates doesn't know if the fees is a word, but it is the word. And that, I'm pretty sure that's how it's spelled. So I don't know where Bill Gates got his English lessons, but I'm gonna go with Google. What does the word defeat mean? Defeat. That probably makes sense. You want to defeat it. You want to annul. You want to get it out of the way. So defeat. Do y'all use the word defeat ever? Am I the only one who uses the word defeat? So defeat, get that guarantee out of the way. So they have $200,000 that they gave us today. We guarantee them a 1.5% return over 8 years. How much money better we have at the end of 8 years? So we make sure we at least get them 8.5%. Can y'all do this on your calculators? You're not going to have an Excel on the exam. You're going to have a calculator. Can you do this on your calculator? So 200,000 times 1 plus 0.015 raised to the 8th power. Does anybody have a number yet? Did you get it $189,000? Could that be right? Do you know that's wrong? Better be more than 200,000 bucks. It's probably not gonna be 600,000 bucks. No takers yet?
611,000.
How much?
I got 611.
You might have accidentally done 15% maybe. Yeah. Anybody get this number? No takers? 225, 298.52. Anybody get that? Michael, you got that? All right. So we're not gonna, you don't need to go out 20 decimal places. So we better have 225,298.52. Now what we're gonna do is we're gonna go out and buy this bond. Now remember, equity annuities are not, they're not regulated by the federal government because they're not considered investments. This is one of the reasons they're not considered investments, because the insurance company is taking risk. They're going to buy this corporate bond. If this corporate bond goes insolvent, the insurance company picks up all that risk. And so that is an argument for why, that's the reason universal life is not considered investment. Because the insurance company is buying these bonds. If they go insolvent, the insurance company picks up all that credit risk. So they're going to go out and buy this bond. How much of this bond should they buy? So step 2 is calculate how much to invest in the 0 coupon bond today. We have the fees amount in 8 years. So we need 225, 298 in 8 years. We're going to invest at 4.5% in something today so that we end up with 225, 298, 52. So what are we going to do? We're going to take that 225, 298.52, but we're not going to multiply this time. This time we're going to divide by 1 plus 0.045 raised to the 8. All right, so someone try that and see what you get. Oops. Make sure you reacquaint yourself with your calculators. I was using a scientific calculator the other day and I was like, my word, there's too many buttons. I'm not a scientific, a financial calculator. I don't like financial calculators. These scientific are just much more logical. I don't know why the financial calculators make you hit 3 extra buttons for some unknown reason. It doesn't add anything to the process. Anybody got it? All right, that sounds good. 57 cents. That look right? I got that. So that is the answer. So make sure you know what the question's asking. How much did the insurance company purchase in the 0 coupon bonds a day to be able to meet the guaranteed minimum rate? They need to have 225, 298, 52 in 8 years. If they invest 158, 426, 57 today at 4.5%, they'll have that amount in 8 years, assuming this bond doesn't go insolvent. There is some risk here because that's a pretty good rate. That's definitely not a treasury. It's a pretty good rate. So there's some credit risk. Maybe it's a triple B bond or double B bond or something. It's got some risk to it, but if it matures on time, then it should mature at 225, 298, 52. Right, so there's the answer to that first question. The second question asks, how many call options should we buy? Now, how much call options will we buy? Each call option costs $500. How much money do we have to invest? So step 3 is determine your option budget. What is your option budget? Well, they walked into the door with $200,000. Where did we get that? That's given right there. They just told us the problem tells you. Well, we don't need 200,000 bucks. How much do we need? We only need to invest 158,426.57. I'm almost tempted to say to ignore the pennies if you want to, but I'll leave them in here. It's not going to matter because when we do the options, we're not going to do fractional options. We're going to round it anyway. So how much money is that? Or can I do that in my top of my head? 41,573.43. Boy, that's probably not even close. Someone tell me the answer. I shouldn't do math in front of a crowd of actuaries. 573.43. How close was I? Was it right? Wow. Okay. Did it? The actuaries had it 3 minutes ago, but at least I got it right. So, all right. Nope, that's not the answer. That's what we're going to use. All right. So we have, and this is pretty cool. I love this I don't like linked annuities, but I love this idea. I use this all the time, especially with senior citizens. Someone wants at a minimum a 1.5% return. So we invest of their 200,000 bucks, we invest 158,000. We've got that 1.8. They no matter what happens, they've got a 1.5% return. But they got 41,000 left over of play money. They could go to Vegas and gamble that. What if they lose that entire $41,000 in Vegas? What's their return going to be? 1.5%. They could put it all in some biotech stock that goes insolvent. How much will they make? They'll make 1.5%. So their worst case scenario is they're going to make 1.5%. That's pretty cool, isn't it? You can tell someone, hey, you're guaranteed. Well, I mean, assuming this bond matures, it doesn't go insolvent. So the question is, what are we going to do with that 41,000? Should we go to Vegas? I went to Vegas for the first time this summer. Really boring stuff. I didn't gamble at all, but I walked by the casino. Really, really boring stuff. I don't know why people go to Vegas. I saw one guy who was like, I walked by like at 10 p.m. He was there. I go by next morning, 8 a.m. He's still sitting there. I'm like, man, what a boring vacation. Because you can do that on the internet now, can't you? Why go to Vegas to do that? Just sit at home in your pajamas or whatever. It sounds like it'd be a lot more fun. But anyway, so we won't go to Vegas. So why don't we go to the stock market and calculate the number of options, not the number of contracts, the number of options. So we have $41,000 to invest. And each option is $500. I won't do that in my head. So we take that divided by 500. And you can round up or down, either way, doesn't matter to me, but that's 83 options. But do it as an integer. Don't do it as don't have decimals out there. Or yeah, do it as a whole number. That's the answer to this question. How many options should the company purchase today? They're going to buy $158,000 today in 4.5% bonds. They're going to buy 83 options. What's the worst case scenario for this investor in the annuity? They'll make 1.5%. You cannot do any worse than that. And really, even if this bond goes insolvent, they'll still make 1.5%. Why? Because the insurance company is going to have to make up that difference. But what if the insurance company goes insolvent? What happens? Well, the state of Texas is going to step in and bail him out. So he's, unless the state of Texas would have to go insolvent for him not to make 1.5%. So he's in pretty good shape. He's going to make 1.5%. But could he do better? Yeah, if the S&P ends up well above 1450, he's going to do better. Right? So any questions up there? What are your questions up to there? This is a pretty cool transaction. Could you see sitting down with your grandfather and saying, hey, what's the worst case scenario? Hey, if I can make 2%, I'd be fine. At least I'll be keeping up with inflation. Say, okay, I'll get you 2%. Because I can put in this mutual fund that's paying 5%. And I'll get your 2% out of that. And I'm going to take all the leftovers. I'm going to go crazy. I'm going to buy call options on Zoom stock or whatever. So you can whatever you think is the best case scenario. All right. So what you're going to do is we move to the future, 8 years in the future, and we have 3 scenarios. The S&P fell to 870. That'd be pretty bad. The S&P just stayed at 1450. It'd be pretty boring. Or the S&P almost doubled to 2850. What we're going to want to do is you're going to fill in this graph here, chart. All right, so you bought this bond for 158, 426, 57. What do you think its maturity value is going to be if the S&P falls to 870? What do you think that's going to be worth? Any guesses on that? You bought it for 158, 426. It's making 4.5%. What do you think its value will be in 8 years? Probably most of the class knows the answer, but they're worried that they don't. You got to step out, take a risk. What's the answer to that? Somebody. No takers? What is 158, 426.57 raised to the 1.045 to the 8? What's that going to be? What is this times 1.045 raised to the 8th power going to be? Yeah, 225, right? Aren't we just undoing this formula? Now that's if the S&P falls. What if the S&P goes up to 2850? What's that bond going to be worth? Any takers on that? It's not a trick question. It doesn't matter. All right. So pretty straightforward. Let's talk about the call option. All right. So call option expiration value. This is also called the intrinsic value. Equals, I should have Stefan or who else was in that class? Can't remember. I don't think many of you are. Stefan, were you? Chris, you're in that class, my investment class, weren't you? Do you remember the intrinsic value of a call option? Starts with the guy's name. What's the guy's name? Max. Know anybody named Max? Max of what? S minus X. Michael, you're in that class. That and what? 0. Times the number of contracts. That's the intrinsic value. We're not taking the gain here because we've already paid the option premium. We're just looking at the option, all right? So we subtract the option. We're not looking to gain in the option. We're just looking at the ending value of the option. All right. So if the S&P falls, let's take the 870 scenario. By the way, what is if it's a put option? So max of strike minus the stock in 0 times the number options. It's just the exact opposite. So in this scenario, we take the max 870 minus, anybody remember what our strike was? 1450 comma 0 times 83. What is that going to equal? Equals 0, right? Because 870 minus 1450 is negative something. The max of that and 0 is 0. 0 times 83 is 0. Take the 1450 scenario. The max of 1450 minus 1450 and 0. What's the max of that? It's going to be 0 times 83 is 0. And then the last one, 2850. So 2850 minus 1450 and 0. There, it's going to be 2850 minus 1450, which is what, 1400? I won't do that in my head. $116,200. Hopefully I did that right. Y'all check me on the math. One thing it's frustrating me as a student comes up at the end of class is, I think you have a math error here. Like, okay, great. Now I got 30 people with math error in the notes. So if you see a math error, let me know. Don't be shy. And Evan was confident and just had a typo. So no harm, no foul, right? There's no shame in that. You just miss the 0. We do that all the time. So step out. All right. So 116,200. So the portfolio is just, you add those two together. That's what your portfolio is. If you did this for your grandfather, this is what you'd have. You have a portfolio of bonds that are going to mature, and you have your option portfolio that's going to mature at the end of 8 years. If you did this, you've got that. If you do this, if you do this one, you'll have that. So hopefully I did the math right. Hopefully you are checking me on the math here. Now, is your grandfather upset with you on this one? Well, if you just went through the 2008 crisis, he's probably thinking, well, you know what? At least I made my 1.5%, so I'm kind of happy on that. Maybe you'd be happy. So what would be your return here? So your return, your annualized return is going to equal your ending portfolio minus your beginning. How much did we begin with? They walked in with what? 200,000 bucks raised to the 1 divided by 8 minus 1. We can calculate this one if you want to. So 225 225 290 298.52 divided by 200,000 raised to the 1 divided by 8 minus 1. Any guesses what that might be? You already know the answer before you even do it. Any takers? Does that look right? You already know the answer to that one. You don't have to calculate on the exam if you don't want to. You know it's going to be 1.5%. Because if you made 0 on the options, then you know all you have is that portfolio that you set up to make you 1.5%. So those two you don't have to switch. This last one, we'll have to calculate this one. So plus that divided by 200,000. Raised to the 1 divided by 8 minus 1. If I did the math right, I get 6.92%. Is your uncle happy there? Well, we'll see. We'll have to look at it and see. So what we're going to do is compare this to the stock market itself. So same thing, ending portfolio 870. Where did the stock market start? We started at 1450. So we'll do the same calculations here. So 870 divided by 1450, raised to the 1 divided by 8 minus 1. So the stock market's down, if I did it correctly, 6.19%. These numbers don't sound right to me, but hopefully I did it right. Oh, yeah, that's the stock market. Okay, what's the return here going to be? 1450 divided by 1450 rise to the 1/8 minus 1. 0%. That one's pretty straightforward. And then we'll try this last one. 2850. Divided by 1450. It's the 1 divided by 8 minus 1. Is anyone getting any of these numbers? 8.81%. There you go. Okay, good. Right. In this scenario, if your grandfather invested in the stock market, he would have lost 6.19%. Now you say that doesn't sound too bad. That's 6.19% compounded for 8 years. That's really horrible. Okay. If he put his $200,000 into that, he would have gone from $200,000 to $120,000. He'd probably been pretty upset. Instead, he had 225, 298.52. So that scenario, he's probably pretty happy. Here he made 150. If he put it in the stock market, he would have just broken it even. So now, of course, we're ignoring dividends, and options do essentially ignore dividends. So he probably would have made more money with the dividends that he did here. Here he made 6.92%. If he put it in the stock market, he would have made 8.81%. So he might have been okay with that. So let's whoa, Bill Gates. So let's do some graphing here. I didn't quite get it, so it's a straight line, but all right, so if you're in the stock market goes up, you make a lot of money. The stock market comes down, you lose a lot of money. Here's the equity-linked annuity. Looks like a hockey stick. If the market goes up, you make money. If the market falls, you got a minimum that you can lose. A maximum that you can lose, a minimum that you will make. All right. Anybody know what this hockey stick looks like? Anybody from my class from last semester in investments? What does that look like? Call option, doesn't it? Isn't that what a call option looks like? Remember with Apple, if we bought the call option for $1.49, what's the worst we could do? if Apple stock falls to 200 bucks, I mean, to $100, most you can lose is $1.49. If it falls to 50 bucks, most you can lose $1.49. If it goes up, you make money. This is what a call option looks like. Right? There's something out there that's really, really interesting. It's called put call parity. It's a really, really interesting formula. A put call parity says that if you have a call and a bond, you should get the exact same thing as if you bought a stock and a put option. And essentially what that's saying is a call option, because the bond is kind of a given. A call option looks a lot like a stock and a put. So what we're seeing in this graph, this looks a lot like a call option. It looks a lot like owning the stock with a put option, because you know, if you have a put option on the stock and the stock price falls, it keeps you from losing more money. This is a very famous line in finance. I love this strategy. It makes a lot of sense to me, especially for people in their 60s and 70s. Makes a lot of sense that they do this. So Article 2, remember Article 2 for your first paper. What did he say human capital had? Had options when you're young. What happens to the option when you get old? They disappear. So what should you do as you get older to your portfolio? Should add options. What kind of options should you add? Shouldn't this be the kind of option you should add? When everything's crashing, you got a minimum that you'll lose. This is exactly the kind of strategy I think older people should have. It makes a lot of sense to me. Let's figure out what's the worst case they can live with, and let's make sure they get at least that. And then let's give them some upside potential. So I like that. That's what the article didn't say to do that. The article said the options should be active management. I don't like that answer. I do think the answer makes a lot of sense. As you get older, you should be putting more of these downside protections into your portfolio, because you know you're not working anymore. You can't, or you don't have many more years to work. You don't have that option. You're 70 years old and the market crashes on you. You're not going to go out and try to find a new job at 70 years old. It's going to be really tough to do that. All right. So I love this strategy. It makes a lot of sense. So the question is, why do I dislike equity-linked annuities so much? Because this isn't what the equity-linked annuity gives you. It gives you this minus a bunch of bells and whistles and fees and caps and floors. It's much worse than this. So my argument is this is a great strategy, but do it yourself without the insurance company. You don't need the insurance company to set this up right. Yeah. Okay, so the return on the S&P is you take the ending over the beginning. You're going to take that entire thing and raise it to 1 over n and then minus 1. So for the S&P, what was our ending value? 2850, right? Isn't that what was in the problem? 2850. What was our beginning value? 1450. How many years do we have? 8 minus 1. So 8.8%. Is that what I had in the table? 8.81%. What was the other one you wanted, Stephen? 7?
And how do the annualized annuity?
All right, so on that one, our ending value was 341,498.52. So you take 341,498.52. How much did we start with? 200,000. They walked into 200,000. 1.8 minus 1. You get 6.91%, 6.92%. Yeah, it's up here.
It's 341, 200,000 minus. It's what minus figure out
How to get to 341?
Yeah.
All right, so the 341 you add across. You add across. So the bond is worth 225, 298, 52. The option we calculate down here, 116, 200. You just add those two. So the equity-linked annuity is essentially, I mean, it's just these two portfolios. Now, the life insurance companies do it like this? Probably not. You're gonna have a really tough time finding a call option that matures in 8 years. So they're gonna have to do some rolling and risk. There's more risk for the insurance company, but they got the people to do it. They can figure it out. For which one?
I think it's for 6.9.
For the 6.9, yeah, 6. So I can't get Bill Gates to let me show it, but there it is. Now be careful on the exam because it might be 7 years or 6 years, it might be 100,000. So don't get so wedded to one particular answer that you forget to change the numbers. So this is a great strategy. I have a blog that I actually write about this strategy. I think it works very, very well. So what I like about this strategy, especially today, I've gotten pretty extreme with this strategy. Right now, I don't believe in it as much as I did 2 years ago, but you have a lot of people that recommend older people do 40% stocks and 60% bonds. The problem with that is that interest rates were so low 3 years ago. Bonds are really, really risky, and you've certainly seen that here. We saw that in my security analysis class before. So what did the 10-year treasury do today? We talked about it last class. What's so big about today on the 10-year treasury? Getting really close to 4%, just shocking. This is the bond that hit an all-time low in 2020 at 0.5%, and now we're almost at 4%. That's 350 basis points in a couple of years. So you can see why a few years ago, putting 60% in bonds probably was not a good thing to do. You would have lost a lot of money the last few years. So what my blog says is, what about instead 100% stocks hedged? I think that could be a much better strategy 2 years ago, 3 years ago, when interest rates were so low. Why? Because the stock market goes up, which it did after COVID. You would have had all that upside, but if it had crashed, you would have had the bottom protected, and you would have probably had it protected at about the same level as you would have lost in the bonds anyway. So you have all this upside, but you would have had the same kind of downside protection. I don't believe this as much today because you really can. I'm actually telling people to start buying bonds again because they're actually starting to look pretty decent. But who knows if interest rates stay as high as, I mean, if inflation keeps really, really high, yeah, bond interest rates could go much higher. But I think the Fed's has shown that they're dedicated to inflation. And last time we saw high inflation in the 70s, we didn't have a Fed that was dedicated to bringing inflation down. So I think Jerome Powell's on a lot of pressure, isn't he, to get inflation back down to 3-4%. So he's going to do whatever it takes. If he has then he essentially told us, I'm taking you guys into a recession if inflation doesn't come down. He essentially told us that. So, you know, he's dedicated. And the stock market reacted very negatively, and he says, I don't care. I'm going to fix inflation. I don't want to be in history books as the Fed chairman who didn't fix inflation. So he's got a lot of incentive to get it right. So I think 4.5% interest rates on the 10-year sounds really, really good to me. Now spreads haven't gapped out that much, so you're not getting paid a lot to take credit risk right now, but you are getting a lot of risk-free rate. So this is what I like about that second article. Yeah, as you get older, you're losing options. The option market has something to offer you. So I hope some of you will write about that in your paper, because I think it's a really good concept to think about. And I think you should start thinking that there's more out there to offer your grandparents than what the traditional financial planner offers. The financial planner offers where they can make money. They can't make money doing this. They can make money doing this. So they're going to push on your grandparents where they can make money. You got to think outside of that and see. So, find some strategies out here. I haven't figured out yet what the best strategy is. I've been experimenting with this all over the place. It's a little tough to get this set up just perfectly. So some of my experiments have shown me some really bad ways to do this, definitely. But I think it's interesting, and it's there should be more papers written on this. There have been some papers written on these type of strategies to try to show they're at least as good most of the time and often much better than this. So that's that stochastic dominance, that they actually have a pretty strong advantage over these type of strategies. We need more papers like that to do that. So you've just seen me tell you that I hate this product and I love this strategy. So it shows you how much I think the insurance industry they're too expensive. They have too many expenses, too many things they've got to do that what's the biggest expense I told you I hate more than anything else? The commission. They got to take 20,000. What did I say? 14% commissions. They got to take $28,000 out of that on day one. If I did that in this problem, what would you have at the end of this? You'd be sunk. There's no way you could get this to work, right? There's practically impossible you can get this to work. What guaranteed rate could you give them if you took $28,000 off of this at day one? It's just not going to work. So you can see how you could do this a lot better yourself if you set it up for yourself. Even if you're not the greatest option trader in the world, there's almost no way you could not do better than the insurance company. Now, the advantage the insurance company has, that they're pretty good at this. They're really good at buying corporate bonds. But you can buy mutual funds that are going to replicate that fairly closely, and you're going to get pretty good returns. If a corporate bond mutual fund has a yield of 6% and it has a duration of 5 years, you're going to make 6% over the next 5 years. It's going to be a pretty good estimate. It's not going to be perfect, but it's going to be pretty close. So you can get pretty close to replicating this. Your struggle is you really can't buy corporate bonds. You can buy corporate bond mutual funds, but you can't buy corporate bonds unless your grandfather has $200 million. Then you can do this yourself pretty well. If your grandfather has $200 million, then why are you sitting in this class? Just go work for him, and unless he has 87 grandkids or something. All right, so what I want to do, I will email you the math problem from last year that we did for this. We can practice. So work that between now and Thursday, and then we'll work that problem on Thursday. Maybe I'll give you one other one as well. Okay. Any last questions on this? This is not, well, you can tell me if you agree with me. This is not a difficult problem. Anybody disagree with that? Is anyone not going to get 100% on this? Everyone's going to get this 100%. I know it's not going to work that way because it didn't work, but I'm hoping. Okay, so we'll work this problem. I'm not going to work any others of this, but there are others out there. Maybe I'll try to find a link to other ones. I don't know how many you need. It's the same problem over and over again. We'll work this. We have an exam next Thursday, so I'll put the exam review out there this weekend. You already know what it's going to be. It's the 3 questions we've been addressing: the ethics question, the term versus perm, and then this math problem. So it's a very straightforward. Each of them are 1/3 of the exam points. So let's work through this. Y'all work it yourself. So you got to do this next Thursday, so you might as well know it now. So it's a $400,000 contract. That's very important. Make sure you get that. The guaranteed is 125. There's a good chance we're gonna have a much higher number for the exam because interest rates are up a lot. That really helps this product out a lot. It's a 10-year maturity. So this is going to be at the end of 10 years. The current level, the S&P. So finally, I've got a number where it's higher than what the current S&P is. Just shows you how much the S&P has been selling off. There's the put premium and 0 coupon. So these numbers will probably be, right now we got it You think about it, the 10-year treasury is now above the number I was using before. So interest rates, it's kind of fun doing my old exams because I can kind of relive history a little bit. All right, so someone give me this formula. What formulas do you need? Step 1. Step 2. Someone give me step 1. Y'all write it down. The formula, not the answer.
You think it's the 400,000 multiplied by 1 plus 0.0125.
All right, everybody understand all that? The 400,000 is the contract. The 125 is what we've guaranteed them, raise it to 10. So that's not the question. But we have to figure out how much that guaranteed minimum's got to be in 10 years to figure out how much we have to invest today. Or is it good? Cadric? Is it Cadric or Cadric? Okay, it's a unique name. All right, great. All right, so step 2, what do you do? Someone besides Cadric. Step 1, and you do what with step 1? Take the value from step 1, and what do you do?
But equals the step 1, then you can divide it. And then contribute 1 plus. No, there's the difference between
0.037, good. Perfect, good. Katie, right? You're Casey, you're Katie. All right, Katie. Casey. All right, Casey. Good job, Casey. All right, good. All right, so let's get these. What, anybody have the numbers? What's this first one? It's got to be over 400,000. Okay. And you can leave the pennies off. That's fine. Does that sound right? 452, 908, 909. It rounds up. All right. What'd y'all get here? You better get something less than 400. Casey, you get that one? You may get it. We're supposed to work this in advance, right? Well, you've already answered, so you're two. 769. Does that sound right? Anybody confirm that number? I'm not hearing anybody confirming. Okay, all right. So that's good. All right, then step 3. Step 4. So step 3 is what? So here we're looking at how many options can we purchase. The guy walked in, or the lady walked in with 400,000 bucks. We invest 295,769 of this. So what's the first step? Oh, did you? Anybody else get another number?
314, 96.
All right, let's try it. I still love that everybody's jumping in. So let's see. Plus 452,908 divided by 1.037 raised to the 10. Sorry. All right, so yeah, it looks like it's a little bit higher. 314,936. Does that sound right? All right, so double check that. What did I just say? 314,936. Okay. Double check. Now, one thing I will say, if it's a math error, there's some math errors you should know are math error. On that one, you wouldn't really know. So if you just had to type, you accidentally typed 3.5 instead of 3.7. You wrote 3s, you know, that you can't really tell. But like here you have a math error and you get 322,000, that's just wrong because you know it has to be more than 400. Or if here you have a math error, you get 416, you know it's got to be wrong because it has to be less. So some things where you know the answer has to be wrong. But on that one, it depends on if you wrote it, and that's one thing, if you write it all out, you probably will get close, if not all full credit, if you just have a typo. Because what you told me was exactly right. Did you have the 452 there? So let's say what you did was you accidentally typed 425,908 into your calculator. And that's why you got 295. I would probably see that and give you full credit. So that's why, but if you don't write it all out, you actually get no credit. If all you write is 295 and I don't have any calculations, I can't give you any partial credit whatsoever. So write everything out. All right. I understand math calculator errors when you're nervous and you're stressed out. So, you know, this is not a class on how perfectly can you key into a calculator. Because how much calculator use are you going to do once you graduate? You may never touch one ever again. So, all right. Anybody want to do step 3? Okay. I can't do that in my head. What is that answer?
1,064.
Oh, good. All right. I guess I had good second grade math teachers. All right. So what are you going to do with that number? That's how much you have to invest. Okay. Did y'all get there? 79 or something? Oh, 73. 73 point what? So 74. Does that sound right? You can definitely leave pennies out on this one. That's perfect. In this case, rounding's fine because it's close enough. Remember, on this one, we're doing one contract, but in reality, there's going to be thousands of contracts. So I'm more concerned. I'd rather you round just because it just makes the math a lot easier. You can round up or down. I can see your point there. On that one, rounding down probably does make a little more sense, but still, with thousands of contracts, they're going to get it pretty close at the full book in business. And here we're just doing one contract. Yeah, I don't count off either way, 73, 74. How many of y'all use 73? Stefan, the only one. So you'll have a slightly different answer, but my answer key has both. So I know, you know, maybe I should have made this. So when you divide it, you got exactly the answer. 73.00000, but then I probably had to go out 20 decimal places there. Okay, then you just complete the table. So what's in this first column? So what was it? This is the ending bond portfolio. Did you say 100 or? Oh, you said 400. I'm sorry. I just said 100. Sorry. I am losing my hearing, so y'all have to scream at me a little bit. That's the same no matter what. So that one you just bring down. So that you get that out of your first step 1. You better have that because that's going to give you the return. So what is your return in those first 2 scenarios? So what is it? Just yell it out. Well, here's the first. Oh, I'm sorry. You're right. Okay. Yeah, I meant right here. So what's your return here? What was the guaranteed? 125. So some of these you could fill in the table after step 1. You don't need anything else. So That makes it really easy. You can just, you might even do that. After you do step one, just go and put those down. So you got a big chunk of your, you have almost half the table right there just from doing step one. Okay, what's the option gonna be worth in these first two? Gotta be 0 because it adds across. Okay, so here you have to do the work down here. So let's do the option values. Someone, oh my word, Bill Gates, why would I want to suddenly go? Why is even Courier an option? Who uses Courier anymore? I wanted to, that's what Courier is, what, like the 1950s or something? All right, so the option in portfolio. Anybody want to do that calculation? No one from the back row said anything. So any back row takers? Some of you had my investment class. You remember this formula? Starts with a man's name. Max. Is this S minus X or X minus S? It's a call option.
S.
S minus X, and the max of that and what? 0. So here you have the max of, well, we're going to multiply that times number of contracts. So here, what's the ending value? $13,670 minus what's our strike? $4,400. 0 times 73 or 74. And what did y'all get for that? It's a pretty sizable number because it's 10 years. So any takers on that? I cannot do that in my head.
I did 73, I got 67, 67, 0.
All right. Say it again.
676, 710.
All right. What is it with 74? I guess it's 685. How much? All right. Okay, and then you just add that across. Anybody have that? It's 888, isn't it? But I can't, I'm not gonna do that. I'm like, does that sound right? And then what was yours, Stefan?
1,100,000.
Okay. Anybody disagree with those numbers? Don't come up at 10:15 and say, hey, I got a different number. That's about 45 minutes too late. Right, and then the returns, you remember Bill Gates, that is a Bill Gates thing. Return is going to equal ending over beginning raised to the 1 over n minus 1, or ratio, a formula you should know really, really well. We use this a lot in finance. I bet even actuaries use this number. So for the 13,770 case, you have 685,980 divided by what? What did we start with? Oh, no, I'm sorry. That's the option. We have 1,138,888. And what to divide? What's our beginning value? 400,000. We have 10 years. I hate it when Bill Gates does that. All right, so what return we get here is Stefan, you probably know yours. Sounds like you're done with college. So Stefan, what did you get on this one? Probably 8 point something percent. Oh, 11.94. Wow, really close. Well, this should be a little bit higher, so 12 point something, but what did y'all get on this one? I don't remember going that high before, but maybe I did. No takers? Oh, we got a lower number. Okay. All right, well, we got an issue somewhere. 1103. Okay, so Stefan, you want to double check yours? Bill Gates messes up on mine.
I think this time to put that on zero or. Yeah.
So 1103. $10.9. That's what, no, I don't mind y'all having. I'm more excited that you are answering than that you get it exactly right, because math errors are pretty common. And was it 1094? You just had a decimal off. I mean, I probably would have given you full credit for that, except when could you be wrong there? If you get a higher number here than you do for the S&P, you did something wrong. Because there's no way this can do better than the S&P. On the upside, it can do better than S&P on the downside, but not on the upside. You can't have something that, hey, the worst case, you make 125. If the S&P is up 10%, you make 20%. That'd be too good to be true. Everybody would be doing that then, right? No one ever buy the S&P again. So, all right. So here we know this one is just 0% because the market didn't move. So we'll have to do the S&P 1230. Divided by 4,400. Raise the 1 divided by 10. Y'all double check my numbers here. I get minus 1197. And the next one, 13,670. I get 12%. Minus 1197 and positive 12. Does that sound right? Was it actually 0.00? Yeah, it was. Wow. Now don't assume that I'm always going to be symmetrical, but I sometimes am. So just so if you get if you get -8 and positive 37, then there's a good chance something was off somewhere. If you get -8 and positive 7.9 or something like that, you're probably about right. And the reason I'm somewhat symmetrical is because of the graph you're going to draw. So, all right, is anyone disagreeing with any of these numbers? So these numbers can make sense now. Now, Stefan, this may go to your point. If you use 74, then yeah, it could be possible you could be a little bit higher, but I doubt it. The rounding's gonna be enough. I'll check both of them. You know, because you had 85 contracts, obviously you could beat the S&P on the upside. But then you wouldn't make the 125 on the downside. Because where did that extra money come from? So hopefully everybody's getting all of these values. All right, so the last thing we ask here, draw a graph. What I want you to draw a graph, I want you to see that call option protected put, that's essentially what this is. Now you're going to draw it by hand, but you got 1.25%. And I'll go with Stefan's numbers, 1094 minus 1197, 0, 12. So you got to graph these, but you have to do it yourself, but you want to have something that's going to look something like this. Y'all see now why it's negative 12 and positive 12, because that's gives me a straight line, because that's what you want. And then you should have the hockey stick. So that's what I'm after, to get the hockey stick. Now you want to label this down here. I don't have it in there, but so that becomes your x-axis. And then have your x-axis be at the bottom. So you want something looks like that. Make sure you draw correctly. So at the 0 point, the equity annuity is higher, right? Because it's 125. So make sure you get that correct. Don't have these in the exact same point. They're not both zeros. All right. So be real clear. Equity annuity does a lot better here. Does worse here. Does slightly better here. All right. So you got to be real clear. Now we know this is the best case scenario for equity annuity. There's a lot of other things going on that makes it much worse, but at least we know. And this is actually what you can build. You could actually create this, because that's what we actually did. Insurance companies don't have that advantage because they have a lot of fees and other things they got to take out. So you're better off building this yourself than you are having the insurance company do it. But at least we have to have a good understanding of the product. Right now, what else do I ask? I don't think I ask you. I don't ask you to explain the graph. I'm really after that you understand that an equity annuity is essentially a protected put or a call option, but with that kind of guaranteed positive return. A call option or a protected put, you have a floor, but the floor is a negative number. Here, the floor is a positive number. Why? Because you bought that bond and you locked in your return using the bond. Does this feel comfortable? A lot of calculator. Make sure you got the calculator down. Always amazes me how a student come in and say, "Oh, I forgot my calculator. Can I borrow yours?" It's like, yeah, but I have a scientific calculator. I do not have a financial calculator. I don't believe in financial calculators. So if you borrow my calculator, it's going to be a scientific one. How many of y'all use financial calculators? Both of y'all? Yeah. So I prefer, the reason I prefer scientific, I've seen students plug stuff into financial calculators, they get the right answer and they have no clue what the calculator just did. I was watching the other day and just got 80,000. You invested 40,000. Your N is 5 equal the rate. I don't even know how to do the RIR. It's not IRR. It's just rate. Let's do rate. You do number of periods, comma, payment from a future priority is 41%. So what did your calculator just do? Didn't it do what we just did? 80 divided by 40 raised to the 1 divided by 5 minus 1. Oh, why did I get a different answer? Oh, that's the right answer. I don't know why. What did I do wrong there? But anyway. I did something wrong. Oh, there's no payment. That's what I did wrong. Sorry. So you can see why I don't like financial calculators. So I have students that can get the 1487, but they don't know what the calculator actually did. That's what the calculator did, what we just did. What percentage of finance students do you think know this formula? I think it's actually a pathetically low number. I'm kind of scared, but this is what you should know as a finance major. Why don't you need to know this? Because you're never going to use a financial calculator again. So you've got to understand it. So that's why, I want you can use your financial calculator if you want to, that's fine. And you can plug that in just like I did here, but I prefer you actually do that. So I actually want you to write the formula down. And don't write it down like this. Because you can see that already, that's meaningless for me. I forgot to put the payment in there. So yeah, I prefer, this. If you can do that, you understand what you're doing. You can do that, you know how to plug stuff into a calculator, but that's not what they're paying you for. I mean, you can have an interview. Hey, do you know how to plug stuff into a financial calculator? Oh, you're hired. We'll pay you $800,000 a year. That's not what they're looking for. They want to know if you actually understand the theory of finance, which is what this is. Ending over beginning to the 1/5 minus 1. That's the number that if you multiply this out 5 times, you're going to end up with what at the end? You're going to end up with 80,000 at the end. Right? That's what finance is all about. I'm kind of preaching to the choir with actuaries, because actuaries really have to understand this, because they have to handle this in a far more advanced way. But we'll talk some about the exam on Tuesday. On the exam, I do give you the exam questions and a rubric on the 2 essay questions, where students are really bad on the essay questions, since you're probably going to be studying this weekend. This is way too high level, way too summarized. I need good, meaty, deep answers. I don't want this to be, high levels, 3 words when I'm expecting a paragraph kind of thing. All right. So give me some really, really good answers. It is open book on the essay questions. That's why I need it much. It's almost like I'm giving you a short paper assignment, since it's open book. All right. So I need really good answers. So I will put the exam review out there so you can start working on your answers this weekend. The answers will be due Thursday at 9 o'clock on Blackboard. You can submit them Monday at 2 a.m. if you want to, but they're due Thursday at 9 p.m. And then the math problem will work in class. So Thursday night, you'll probably leave early, because that's all we're going to do is work the math problem. We're not going to have class afterwards. All right. Other questions on this? Huh? Yeah, as long as you need. Yeah, I don't think it'd take that long. I've been here past 2 a.m. waiting for students. The most irritating ever was a student that stayed well past midnight, turned her exam, it was over half blank. Like, you didn't do well, and you made me sit here for 2 hours. It's like, why do that? That was very irritating. All right. So how do you compare annuities? The most important one is crediting rates, and that's what most people look at. And here I'm talking mainly deferred annuities, but it's also true for immediate annuities. You got to be careful on the crediting rate, because there is this bait and switch a lot of companies do, or they really have a great rate when everybody's paying attention, and they flip to a much lower rate. Surrender fees can be really, really important. A lot of these firms, if you surrender in the first year, they're going to charge you 12%, which is material. If you give them $100,000 and then you change your mind, they're going to take $12,000 of your money. So, that can be really material. A lot of firms, it will be a declining, so they'll charge you 12%, then 11%, then 10%. And then at some point, it just goes away. USAA, they had what they call these legacy annuities, where they had these guaranteed minimums of like 4.5%. And their surrender fees dropped down to $25. Now think about it, you know, you've got, well, actually on the guaranteed minimum on the surrender fees, if it's $25, that's not a $500,000 policy. $25, that's not much of a deterrent at all. You're going to do what's in your best interest. The guaranteed minimum fees, credit rates, that might keep you into a policy that you will never surrender just because the minimum is just way too high. And then you may have some other expenses. So you just line all these up, make sure you write them all out, compare one product to another, and just see what gives you the best deal. It could be all over the place, so it may not be an obvious answer which one's the best one, but these are the things that you're looking at. All right, so we're going to talk about longevity annuities, but I'm going to give you a math example where I'm going to try to get you thinking it's the greatest product ever invented. But longevity annuities started coming out. This is one of the first articles I saw in the early 2000s. But I hate the product that they show here. I'm going to show you a far better product than this one. They say it's a relatively new product. So in 2010, they're saying this is a relatively new product to protect you from running out of money if you live too long. This is not a deferred annuity. This is it's very different. A deferred annuity is you give them money and they invest it and then you retire, you then annuitize it. This is a very different thing. So what this is an immediate annuity, but an immediate annuity doesn't pay you immediately. So you give them $100,000, and then if you live, you get a certain amount. If you die, you get a certain amount. So I'm going to show you my annuity, which says if you die, you get nothing. They don't structure it like that. The insurance removes some of the uncertainty about how much you can afford to spend in retirement, is be able to spend down your portfolio. We saw that with your papers, your articles 3 and 4. The huge advantage of these products is it allows you to comfortably spend your entire corpus. But with this product, you don't start getting the money immediately, you actually delay it. So what are you looking for? So the key here is you invest today, hope people die, and you survive and get their money. That's essentially what we're looking for here. So you invest today and you wait for 20 years. And during that 20 years, you're hoping a bunch of people die because the ones that die are giving you, you get their money. All right. Now, that sounds really bad, but you don't care which ones of them die. So you're not like picking people. You're not like going around the city and saying, hey, you have any these annuities, and you're putting hitmen out on them or something. But you just want more people to die because that gives you more money. Some companies allow your heirs to receive some or all of your money. So that you don't want. You say, hey, if you die in 5 years, we'll give your estate some of the money. Because if you do that, that means if you live, you're getting less money. You want to really load this thing up. So I think the best thing you can do is say, hey, if I die, I get nothing. But if I live, that's going to give you the highest payout. You're going to see it in the example I'm going to give you. Now, here's where it's so bad. This product is terrible. I promise you, you're going to love my product far, far better. This is a terrible product. So they pay $18,000 to get $1,000 of money. So at 65 years old, they pay $18,000, and if they make it to 85, they start getting $1,000 a month. That doesn't sound good at all, does it? If they bought an immediate annuity at 85, it would have cost them $211,000. Well, obviously, because you're 85 years old. So, well, I don't know. We'll look at the math. We're actually going to do some of the calculations. They talk about inflation. I'm going to ignore inflation. You're going to see with my product, inflation is not an issue. This is a MetLife product. When I saw this article, guess what I did? I called up MetLife and set up an appointment. And I went and sat down with a MetLife person. The first thing he says is, I can't sell it to you because it's not authorized in Texas yet. The second thing he did was try to sell me another product. What product do you think he tried to sell me? It wasn't equity linked annuity, but that would be my first choice. But what do you think he tried to sell me? Do you think he sold me the best product for me or the best product for him? What do you think he did? The worst for him. So he sold me a high commission product. Any guesses? Not universal, which you're in the kind of right category. Put a V on front of that. Yeah, he tried to tell me a variable universal life policy. It's like, are you kidding me? I talk about in my class how horrible that is. He knew I was a USA officer, so he thought I was there as a spy. And so he was real leery the whole thing, but I wasn't. I was actually asking for myself. I was real curious about the product. And then he wasted my time explaining to me how the stock market works. I'm VP of equities at USA, and he's explaining to me how the stock market works. It's like, so I kind of pretended like I had a meeting to go to, and I got away from him as fast as I could. Very strange. I can tell I don't like life insurance salespeople, because it's just, I feel like it's just, I feel dirty when I leave. It just doesn't feel right. But anyway, that's what he pushed. This guy, I'm going to tell you this story because I just think it's incredible. This guy lost his job a few years later. He called me at USA to see if I could get him a job. It's like, just, yeah. So he's not the reason I don't like life insurance salesmen, but he just is an example of why I don't like them. It was a very strange encounter. But anyway, this is their product. You can read through their product. I think this is a horrible product. And I'll show you my product, and you can go back to this article and you'll see, but we're going to do it later when we get into the pricing, because we need a mortality table to see my product. I'm tempted to show it to you now, but I won't. Here's another article on annuities. All right, so this is someone who figures out how to rip off a life insurance company and do it in a very legal way, although he ended up going to jail, but I think for other reasons. But anyway, this guy, Cara Madre, isn't that like a face mother or something? What is Cara is face, isn't it? And Madre is so face mother. That's kind of a strange last name. Does that name sound strange in Spanish? Cara Madre, or is that a common name? Huh? Oh, does it? Okay, well, I'll be careful on that. My Spanish teacher, her English is not very good, and she's asking about these bad words in English, and she's just saying them. I'm like, but she doesn't know they're bad words, because to her they're not. I'm like, no, please don't say that word. Okay, so this guy, what he discovered is in annuities, the deferred annuities, they have this death benefit that if you die, we're talking about a variable annuity. So if you die, the insurance company gives all your premiums back to you. If that's worse than what your portfolio is. So if the stock market took off and is up 40%, then you get that. But if the stock market crashed 40%, you get your premiums. That sounds like a good deal. What most insurance companies just kind of ignore that. That's like, yeah, that's not that big of a deal. And then what happened? 2008 happened. And suddenly people have this, and we'll talk about that. That's why Hartford almost went out of business. But let's look what he did. He looked at a clause in a contract which allowed him this incredible payoff. Now, all right, let me just tell you what he did. So he went out and found a bunch of people, and he says, I'll give you $1,000 if you will be the person on this variable annuity. And so here's $1,000, and it's my annuity. If you die, I get your premiums back. If the stock market crashes, if the stock market's up, I get the upside. So what has he done? He just paid $1,000. The stock market's up, he makes a bunch of money. Stock market's down, he doesn't lose anything. And guess what kind of people he does this with? Really, really sick people. Now, really, really sick people don't buy annuities, do they? So what is he doing? He's found a way to invest in the stock market without any downside risk. He's essentially created his own equity-linked annuity, but he doesn't have to pay the commission, and he gets it really, really cheap. And he was doing this left and right. and just making a fortune. He's a smart guy, isn't it? Isn't he? Pretty smart guy. The prosecutors say he's an unscrupulous con artist who's engaged in identity theft and fraud. He deceived the terminally ill. Now, how did he harm the terminally ill? He gave him $1,000. Tell me the harm of the terminally ill here. Do y'all see any harm here? I mean, if he hadn't shown up, where would they be? They'd be $1,000 poor. I don't get that side of the argument. I don't see how he's harming them at all. He preyed on the sick and poor. Who did he really prey on? He preyed on the insurance companies. Are any of y'all shedding tears right now? Oh, I can't believe he's ripping off these poor insurance companies. He transformation of life insurance industry away from its traditional business. So it's the insurance company's fault. They got away from their traditional business and went into the investment side. He took advantage of that and said, hey, you know what? You left a little insurance on your product, and I'm figuring out how to rip you off on that. That's what he did. The insurance companies came up with the rules. All he did was exploit it. But I think it's funny. The insurance industry says, oh, he's taking advantage of the poor. No, they just left out a couple of words. He's taking advantage of the poor life insurance companies. That's the part they left out there. The federal judge hearing the civil case agreed with Karamadri's contention that he was doing what the fine print allowed. The annuities also typically include life insurance component called guaranteed death benefit. With this guaranteed, if the market crashes, but you die before, your beneficiaries get the lump sum. So what did he do? He got these people and said, buy this annuity, make me the beneficiary. Here's $1,000 if you do that. And so the court's saying, yeah, but his beneficiaries didn't get anything. Why did he get this? But he gave him $1,000. His kids and their kids and grandkids didn't give him $1,000. So, you know, you see the question there. They sold $1.4 trillion of these things. So he said he didn't like the products because they were overcharging. So, you know, it's interesting. Now he discovered that they did not need insurable interest here. That was pretty important, right? Because he had no insurable interest in these people's lives. But Rhode Island said you didn't need insurable interest on this type of deferred annuity. There is no requirement that the investor and annuity be the same person. So the fact that he paid the premium, not the person whose life was there, that was perfectly fine as well. Now think about this guy. I don't know his background, but he sat down with these contracts and went through. These are pretty complicated contracts. He discovered a annuitant didn't have to have a relationship with the investor at all. Whose fault is that? The insurance company. Who writes these contracts? The insurance company. They could buy an annuity on the life of someone who was not expected to live long in pocket. If they choose well, the account went up and they reap benefits. If you choose poorly, the death benefit kicked in. He was setting himself up and his clients at the demise of strangers. What strangers? Again, the insurance company. So there really wasn't much the insurance company could say. Why he ended up losing at the end of this, that I don't remember, but I don't really see that he did anything illegal based on what's in the article. It sounds like there was some things that he did that were a little sketchy that got him in trouble, but anyway, it's interesting. I actually kind of like this guy. I don't know what he did that was in error, but I kind of liked him. There may have been some fraud in how he got the people to take his $1,000. Maybe he wasn't upfront with them exactly what he's after and trying to do, but I don't know. I lose my mom, who is my best friend, lose my mother forever at 64. In turn, profit and gets X dollars. It's slimy what the man did. No, what was slimy is she didn't think of it before he did. Because that would have been a lot better. She could have done this whole thing, couldn't she? I think she's mad that he didn't tell her to do it. But what incentive does he have to do that? You think he should go around and say, hey, you should buy a variable annuity on your mom, she's really sick? Maybe he should have done that. Say, you know what? I'll give you $1,000, you do this, and you do it as well, Deborah. Maybe that's what he should have done. He told the daughter, you do this as well. But does he really have a responsibility to do that? I don't know. He does sound a little slimy, you know, hey, I'm looking for someone who's about to die here. So prosecutors alleged that he and his accomplices fraudulently obtained $15 million from the insurance company. He didn't do badly. $15 million is not that bad. All right, it's a long article. If you want to read through it and just see what all, you could probably Google him. There's probably an Wikipedia page out there. It's a really long article. So they had a 66 count indictment against him, and whoever that guy is, my word, that doesn't look like a Spanish word. All right. Okay, we covered that. All right. So I don't like linked annuities. I don't like variable annuities. I don't like variable life. My main thing is they're too complicated. There's too many expenses. My bottom line is any product that has a 10-15% commission, there's no way it can be good. There's no way mathematically you can work that thing out. So it's good. With variable annuities and variable universal life, maybe after 30 years, you can get all that back because of all the deferred tax. But there's got to be a better way for you to work that out and have to pay 15% up front to get that product. All right, y'all ready to shift gears here? So what I want to do tonight is set up where we're going, because you don't want to waste time. Paper 2 is a massive paper. It's a research paper where I've done all the research, but you still have a lot of writing to do. The rubric is massive. It's got like 40, 50 things on it. And we're going to be going through this. And what you want in the paper is some quotes, some actual data, numbers, some charts. And I'm going to be going through that in class. It's a little tedious, except for I think a lot of stuff is really quite interesting and pretty cool. So we're going to have some interesting conversations. You can sit there and stare at me blindly. You can be distracted with other things, you know, checking Facebook, which irritates the life out of me. Or you can be writing paper 2 in class. What sounds more intelligent to you as a college student? Do it in class, because you're sitting here at 9 o'clock. That's what you should be doing. You should be saying, wait, professor, I need to get that in my paper. Where was that? That was page such and such. I really want that. All right. So I'm in a sense going to help you write the paper in class as we go through it. So let me show you what you have out there. Oh, William's giving me the answer. Okay, good job, William. I don't know if that was the right answer or not, but it probably was. He's a smart guy. All right. You're not believing me that this is a research paper, but let me show you what's under there. So here's the files for paper 2. Here's the rubric. Don't pass out. But here's the rubric. So there's your rubric. So the way this paper is written, it's a health insurance reform paper. It starts off with an introduction, just sizing up the problem, and then it's problem solution. Okay. The problem piece, it's just going to go through. Now, a lot of students, this is the order of their paper. They just go exactly in this order. You don't have to do that. I don't think it's actually the most logical way, but some students say, just to make sure I cover everything, I'm just going to do everything you do. So essentially what you're doing is making sure you understand each one of these. What do we mean by overtreatment, overdiagnosis, which is, you notice, is twice as much as some of the others. So you're trying to get each one of those understanding. What I mean by inefficiency is encouraged. You're going to see a lot of that in the video I want you to watch. In fact, some of the doctors in that video are going to say some really shocking things. And you might think this is skewed. I remember I had a, I may have told you all this story before, but yeah, I had a healthcare administrator and a doctor in my classroom. The administrator was just bad mouthing the healthcare system left and right. He kept apologizing to the doctor. Did I tell you all this story? And the doctor said, that's okay, keep going. And then it was the doctor's time. And he was harsher on the healthcare system than the guy who started. It was just amazing, some of the stuff this guy was saying. So there's some bad incentives out there. I mean, a good example is, and I'll tell you the story again, but just to give you an example of what I mean. So there's more here. You can't just in your paper say, oh, and inefficiencies encouraged. That's not enough. So there's a guy who figured out a way to save hospitals a lot of money, or I'm not saving money, to greatly reduce error rates. They were killing people and harming people, and he discovered a way to reduce those error rates dramatically. He met with the CFO and showed them a really simple process to do that. And the CFO said, why would we ever do that? We make a lot of money fixing our errors. That's the incentive of the industry. You go to the hospital, you pick up a virus because someone didn't wash their hands. You have to go back a month later because of the virus. They make an extra $10,000 on you. The CFO says, yeah, we're better off giving them that virus, giving them that disease, because we make $10,000 correcting our error. That's essentially what they're saying. That's the inefficiency is encouraged. You're going to hear on that video, some of the doctors are going to say that. One doctor is actually going to say, I don't remember the exact words, but he said something along the lines, I'm paid more to harm my patient. Does that sound like a good system? That might sound worse than equity into annuities, right? Because at least they're not killing people. So you need to have this kind of stuff. I'm going to go through these in class, and you're going to need quotes and data, and I'm going to give them to you. But if you wait to the very end, you have to go back and start over from scratch and get all of that. So you need to be doing that as you're going. Now, on the possible solutions, you're definitely going to hear my biases. But I also know I'm clueless on this because this is so complicated. No one has the answer on this. So I'm going to say, here are my biases. This is what I think the solution is. And I'm also pretty sure it wouldn't work. Okay. I don't think anyone. So, I wish we could have President Obama here to debate me. He's a lot smarter than I am, but I still would love to debate him because there's some things I think he's wrong on. I just want to hear his answer on that. I wish I could have Hillary Clinton here to debate this. I don't know which of the two I would. Hillary Clinton and I would probably be in a fist fight by the end of it, but President Obama and I would probably. So I don't know. I just have a sense that she's a lot more. I think she got much more beat up with it, so I think she's much more sensitive about this issue, whereas Obama actually got his bill passed. But I don't know. I don't know what Republicans I have here because I'm not really sure what their actual proposal would be. But I have a huge advantage to you. Your solution doesn't have to be politically viable. All right, you're king of the world. You can do whatever you want. Okay, so you don't have to worry about Republicans, Democrats. In fact, you're going to be surprised on some of these articles. Some are written by far left, some are written by far right, and you're going to be surprised how much they agree with each other. Okay, the solutions are out there. It's the politicians that are messing it up. Why is that? Because the politicians make a fortune from this industry. If they solve the problem, their campaign contributions go down dramatically. So they don't have an incentive to fix the problem. But you don't have to worry about it. You get to do whatever you think makes sense. You have to talk about these solutions, even if you don't like them. So you can say one possible solution is this. I don't think this works because, all right? So you still have to go through them. You can have your own. So if you want to do Medicare for all, that can be your solution. You still have to talk about the other ones, okay? So I want to know why you don't think tax credits is the right answer versus tax deductions. I want to know your view on that, okay? One thing you're going to see in almost every solution from the right and from the left is reduced amount of insurance we're using. So the insurance industry gets crushed in most of these proposals. We'll talk about why that's the case. We'll get into that. Why is that a big part of the problem? When you look at the articles, The first article is a short one, and it's a very old article, but it's extremely well written, and so I'll just stick with that. You're going to find sometimes I'll have old articles just because it's better written than current ones, and unfortunately, articles written a long time ago, nothing's changed. It's the exact same problem. So we haven't fixed. Affordable Care Act has not addressed it. Why? Because the Affordable Care Act was focused on the demand side. Where do you think the problems are? They're on the supply side. All right, so that's why nothing has changed. Now, if President Obama was here, I think he would tell you he would agree with me on that. Why didn't he address the supply side? Because what did Hillary Clinton do? She addressed the supply side, and what happened? She got crushed by the health insurance industry. They moved out all these negative articles. Now, what elected position did she have when she did all this? What was her official capacity? She was wife of the president. All right, so she was put in charge of this. President Clinton put Hillary Clinton in charge of this. Y'all know what? It's HICFA. You know what HICFA is? It's a big federal agency, but they changed it to Hillary Can Fix Anything. So she got her initial. So she got so beat up on this. And then when she ran against President Obama, she actually knew this much better than he did, because she'd been working on this for 8 years, right? She was, and there were some places where it looked like she was just going to explode. She got so mad at President Obama, especially when there's one thing he criticized her on, and he did the exact same thing when he became president. And she got so, I think she almost had a heart attack. She was so this political stuff, it's terrible, because what politicians do is they know what they're saying is not true, but they say it because they got to get the votes, and that's part of the issue with this. So you're going to see, when you get away from the politicians, there's actually people out there with solutions that they agree. So this one is that. The second one, so this guy is a very far right Republican libertarian. This person is very far left, Democrat, almost socialistic in some ways, and they agree about 85%. All right. This one's a short article. This is a very long article, but the nice thing about the long articles is, guess what? I highlighted them for you. And you can get away just reading the highlighting. Not only do I highlight it, but I even highlighted the highlights. So you'll see the one I do in class, I have highlighted of the highlighted, the ones I really want to cover, okay? But this is a long article, goes 18 pages. Not only that, but he wrote the book by the same title. And I've read the book as well. The book goes in more detail than this. I'm not asking you to read the book. So y'all getting a sense of what this paper is all about, all right? And then this last book, oh boy, I love this book. I think you should read this book. These are two Cato Institute people. If y'all know Cato, what is Cato's political position? Anybody know? Cato.org. Democrat, Republican? No. Socialist, Libertarian? Which do you think? Cato, y'all don't know Cato? Y'all heard of Cato? Yeah, we talked about it with auto insurance. Yeah, so Cato is about as libertarian as you can get. We had one of the students in my class who went and worked for Cato. I was so proud. We had someone from Cato, and then he got his PhD and went somewhere else. But yeah, so this is very libertarian. They say this is an incredible, a very long book. Almost half of it is their bibliography. And I had a tough time writing this book because every footnote was an article or another book I wanted to read. So it was like, I'm never going to get to the end of this. So very, very well researched. And so we will use some of this book. There's just some amazing, amazing stuff in here. I typed all of this. And I typed all of this from the book because, so, I mean, it's, the way I actually did it is I read the book into a software package that translated it to written words. And so there's some typos in here because I don't speak all that clearly. But there are some really amazing things, especially So here's one thing I will say, if you're gonna be a Medicare for all person, that's fine. But you're gonna have to address the issues we bring up on Medicare. Okay? You can't just say Medicare for all and leave it. Now, if you want to go out to Bernie Sanders' website and get some things to bring in, 10% of this paper is other. So you do have to go out and do a little bit of extra. It can be on one subject where you just go deep dive. So if you want to go to Bernie Sanders' website and get his arguments for Medicare for all and bring that in, if that's what you think, you can do that. But you still have to address some of these really serious issues. And they raise some pretty serious issues on Medicare. Their solution is very similar to the first two articles. We'll talk about this healthcare reform impacts women much different than men. So Porter, and we're going to do Porter. So Michael Porter, you've heard of him, Porter's Five Forces. He's also a heavy writer on healthcare reform. We're going to look at his outcome-based solution, outcome-based medicine, which I love his article, but I'm not sure how practical it is. We'll see. And then I want you to watch a video that's also very, very old, but still very current. I wish PBS would make an update on it. It's called Money in Medicine. I want you to watch it. There's probably some quotes and data you want from that. Well, one of my students was doing this class for his honors college, whatever you call it, dissertation thing. I don't know what you call it, but you know, honors college, you can do a paper. So what I told him to do, watch this video and create really good notes. So you have his notes that you can follow as you're listening to the video. I still want you to watch the video. And he's a really smart student, so they're really good notes. I mean, well, you're all smart students, but he was really, really smart student. So this is what we're going to walk through. There's one place where I go really crazy. And every article I could possibly ever find is in here. And it's 138 pages, but it's highlighted. Okay, so we're going to hit the highlights. There's a lot of good graphs. Some of the articles are very old. Some of them are just last month. So we're going to go through that. So y'all can see it's going to be pretty intense. So come to class to do your paper. You probably want to bring a laptop, I would think. And probably if I were you, I would have the article on. If you see something you like, copy and paste it and put it on your paper. I would recommend you do that. And organize as you go. So as I say, we're talking about overdiagnosis. Have that as part of your outline. So maybe you have the rubric up. Maybe you copy and paste the rubric in the Word. As you see something, you put it as that part of the rubric. All right. You'll see where we're going here. Not everybody's going to do that. And some students are going to be really shocked when they write this paper because it's a bear of a paper to write.